Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
After listening to today's news, you'll know. First, global oil prices plunge in their longest losing streak as hopes for a Russia-Ukraine peace deal clash with OPEC plus production policy. So we'll discuss why this geopolitical uncertainty is roiling energy markets and what it means for the global fight against inflation. Second, Argentina's Vaca Muerta shale boom generates a $5.7 billion energy surplus, but capital controls create a paradox for its economic comeback. We'll examine how this financial bottleneck is testing investor confidence and could impact Argentina's ambition to compete in global LNG markets. Third, Leonardo's AI-powered Michelangelo Dome signals a European defence supercycle, sparking a high-stakes battle between legacy giants and AI startups. Today we'll take a closer look at this technological arms race and its implications for the future of the NATO alliance. Global oil prices are in their longest losing streak since 2023. Brent and WTI crude are on track for a fourth straight monthly loss as rising supply weighs on the market. But this isn't just a story about supply and demand. The fate of the entire energy market now hinges on the high-stakes geopolitical drama unfolding this week. A significant portion of the oil price is what experts call a geopolitical risk premium. That's the extra money traders pay because they're worried about potential supply disruptions from conflicts. Right now, the market is betting that peace might be on the horizon, so this risk premium is starting to evaporate, pushing prices down. But, this optimism might be premature. If the talks suddenly collapse, that risk premium could snap back violently, causing a sharp price spike that would complicate the fight against inflation for central banks globally. The first major shockwave comes from potential peace talks between Russia and Ukraine, led by Washington. A deal could lift sanctions on Russian oil, unleashing a torrent of new supply. All eyes are on Russian President Vladimir Putin, who just stated that draft proposals could become the basis of future agreements, but then delivered a chilling ultimatum. If not, Russia would fight on. This single statement is holding traders captive. Now, for our audience in Asia, this has some very specific implications. For the past few years, China has bought Russian Urals crude at a significant discount. If sanctions are lifted, Europe will likely re-enter the market, competing for those same barrels. This increased competition would almost certainly erase China's price advantage, raising costs for its industries and potentially impacting its export competitiveness. The era of discounted Russian energy for Asia could be ending, but that's not the whole picture. The real turning point is what's happening with OPEC+. While the world watches the peace talks, the cartel is expected to meet this Sunday, and sources indicate they will likely leave oil output levels completely unchanged. Even as they hold production steady, OPEC Plus is quietly conducting a major review of each member's maximum production capacity, which is a stress test for the group's unity. This process is creating significant internal tension. Countries that can pump more, like the UAE, have different goals than those already at their limit, hinting at a growing risk of a future price war if they can't agree on quotas. The group's cohesion is being tested, and a failure could destabilise the market. This sets up a massive collision course. We're seeing the potential for a peace deal that could flood the market with oil, while at the same time, a powerful cartel is determined to hold the line on production. An analyst at IG Markets put it bluntly, saying participants are reluctant to position aggressively until concrete progress or a breakdown materialises. While whispers of Federal Reserve rate cuts and a drop in US oil rigs offer some support, they are dwarfed by the main event. Now, get this. The US oil rig count, a leading indicator of future American production, has now fallen to a 4-year low. For years, the explosive growth of US shale oil acted as a cap on global prices, making America the world's swing producer. This new data suggests that role is diminishing, with US shale becoming less responsive. Price-setting power is shifting more decisively back to OPEC Plus and major geopolitical events. The global energy market is now caught in a power struggle between a potential geopolitical reset and the established order of OPEC Plus, with billions of dollars hanging on the outcome. We were just talking about the major players dictating global oil supply, but now let's turn to a story where a single region is trying to rewrite its country's economic future. In a nation famous for battling debt and inflation, one sector just created a $6 billion energy surplus. This isn't a story from Wall Street or Silicon Valley. It's from a 30,000 square kilometre geological formation in Argentina called Vaca Muerta. After fracking unlocked its massive oil and gas deposits, It completely upended the country's energy landscape, now accounting for more than half of Argentina's total production. The boom has transformed sleepy rural towns into frenetic industrial hubs, but it's also creating what economists call a two-speed economy. In Añelo, the population soared by over 60%, and the town is now swarmed by an extra 15,000 workers every weekday. This intense local activity is causing a pocket of localized inflation in wages and services, making it incredibly difficult for the central bank to manage the national economy with a single policy. For the first time in decades, Argentina is energy self-sufficient. This shift is creating a massive trade surplus in the energy sector, $5.7 billion in 2024, its largest in 18 years. That's a crucial source of hard currency. The country desperately needs to pay foreign debts and stabilize its reserves, with projections showing the surplus could grow to $8 billion in 2025. However, if you zoom out, you'll see another layer to this story. This gusher of black gold comes with a massive catch, a financial bottleneck preventing a national comeback. The central conflict was laid bare by one former official who quoted global energy giants saying, "I haven't been able to get a single dollar out of Argentina for 15 years, so we make money, but we have to reinvest it there by force." That's the trap. Strict currency controls designed to stop capital flight are now strangling the very industry that could save it. After all, the flow of foreign direct investment serves as a real-time gauge of investor confidence. If companies can't take profits out, they become hesitant to bring more money in. While President Javier Milei has lifted some restrictions, major roadblocks remain. A surge in investment after these controls are fully liberalised would signal a major turning point. We are already seeing positive signs. For example, US energy giant Chevron has committed to boosting its production there significantly. A clear vote of confidence, add in a poor national credit rating and a critical lack of infrastructure, and the full picture emerges. To solve this, major projects are underway, like the Vaca Muerta pipeline, a multi-billion-dollar project designed to get more crude oil to the coast for export. Its success is a critical indicator to watch. The situation presents a fascinating duality. On one side, a nation sitting on a resource goldmine, yet on the other, it remains shackled by its own financial system. This is a classic test of the resource curse paradox, where resource-rich countries often experience slower economic growth. Whether Argentina can use Vaca Muerta to achieve sustainable growth or falls into this trap depends entirely on fixing these financial and infrastructure problems. It proves that getting the oil out of the ground is only half the battle, and the ambition doesn't stop there. Argentina is now making a serious push to become a global exporter of liquefied natural gas, or LNG, using gas from Vaca Muerta to compete directly with suppliers like the US and Qatar. This would require billions in foreign investment for new export terminals, but if successful, it could create a whole new dynamic in global energy markets. Speaking of countries trying to carve out a bigger role on the world stage, Europe's defense industry is in the middle of its own seismic shift. Italian defense giant Leonardo has just announced plans for the Michelangelo Dome, an AI-powered shield to protect cities from missile attacks, and it's sending shockwaves through the market. This move is part of a sector that is already on fire. Let's start with a single statistic that might just change your entire perspective on this company's environment. While Leonardo's stock is up around 77% this year, Germany's Rheinmetall has skyrocketed an incredible 148.9%. This isn't just a temporary reaction. Many experts believe we are witnessing the start of a European defence supercycle, fueled by a massive push for sovereign defence capabilities and a €150 billion EU procurement program. This has huge implications, as total European defence spending is expected to hit €343 billion this year. If massive long-term projects like the Michelangelo Dome secure continent-wide contracts, it could fundamentally re-rate the entire sector's valuation for years to come. But what really brought this to a head was the next development, a fundamental shift in the nature of warfare. As one top equity analyst at Morningstar stated, modern warfare is won by the network that can integrate every platform into one decision cycle. The winners will be the contractors that own the network layer, not the metal. This is the new gold rush. The Michelangelo Dome is being built on an open architecture designed to operate with any country's defense systems. Think of it like using USB ports, standardized connections that allow different devices to work together seamlessly. The goal is to avoid being locked into one supplier and allow for rapid upgrades. This vision of a unified European shield will certainly be tested, though. Here's where it gets interesting. Individual countries often have their own industrial policies and prefer to protect domestic companies. This could lead to a fragmented system of competing standards rather than a truly unified network, undermining the goal of an effective, cost-efficient European defence. Leonardo's CEO Roberto Cingolani framed the stakes, saying that in a world where defending is costlier than attacking, defence must innovate. And believe it or not, a new class of defence tech startups is challenging the old guard. German AI drone startup Helsing just saw its valuation double to 12 billion euros. This represents an existential test for legacy giants like Leonardo. The startups are AI native, built from the ground up on software. In response, legacy players are scrambling to adapt. Leonardo's new industrial plan is a two-pronged attack, strengthening its core business while aggressively pushing into AI, cybersecurity, and space. The battle for Europe's security is no longer just about military hardware. It's a high-stakes technological conflict, and the companies building the smartest networks are positioning themselves to dominate the future. So, looking ahead, Europe's push for sovereign systems driven by concerns about US reliability could paradoxically create friction within the Western alliance. A key focus will be whether these new European systems are compatible with NATO standards. If Europe develops its own separate standards, it could undermine the West's collective security. Furthermore, these ambitious projects are incredibly expensive, and any cost overruns could force governments to make difficult choices between defence and social programs, testing political support.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.